Hey everyone! Following my latest video on Misue, today we are going back to CHAGEE. Since my first video, the stock has roughly been cut in half, so I think it's time for an update. The first thing that stands out is how quickly CHAGEE expanded its network over the last 4 years. In the Misue video, we saw that the total number of stores almost tripled between 2021 and the end of 2025. With CHAGEE, the network increased from fewer than 500 teahouses in Q1 2022 to more than 7,500 in Q1 2026. So it has been multiplied by roughly 15 in only 4 years. Of course, CHAGEE was starting from a much smaller base, but the expansion is still quite impressive. The similarity with Misue appears in the most recent quarters. In Greater China, CHAGEE's store count has started to stabilize, with very little growth between Q3 2025 and Q1 2026. We saw something similar with Misue, where domestic expansion has also started to slow down. So for both companies, opening additional stores in China is clearly becoming more difficult than it was a few years ago. Where CHAGEE is currently doing much better than Misue is overseas. Misue actually reduced its international store count between 2024 and 2025 after expanding too quickly in some markets and encountering operational, hygiene and food safety issues. CHAGEE is still moving in the opposite direction. Overseas teahouses increased from 94 in Q1 2024 to 374 in Q1 2026. While overseas GMV increased from around RMB 96 million to RMB 426 million. So the growth in sales has broadly followed the growth in the network. And for the moment, we don't see any obvious deterioration in sales per store internationally. This is probably the area where CHAGEE currently has the strongest momentum. If we now look at total GMV, however, the picture is much less positive. One point to clarify is that I am using trailing 12 months GMV for the quarterly figures, which makes them easier to compare with the annual historical data. Total GMV has basically been flat for around a year, remaining between roughly RMB 31 and RMB 33 billion since Q1 2025. That is clearly disappointing because the number of stores continued to increase during the same period. So if the network is still expanding while total GMV is no longer growing, average sales per store must be falling. And that is exactly what we see here. Average monthly GMV per teahouse in Greater China fell from around RMB 512,000 in 2024 to RMB 356,000 in Q1 2026, a decline of almost 30%. The low point was Q4 2025 at around RMB 337,000. There is at least a small sign of improvement in Q1 2026, but it is obviously far too early to say that the trend has reversed. Part of the decline could simply come from rapid store expansion, because newly opened stores generally need some time to reach the sales level of mature locations. This is why the same-store data is particularly useful. Unfortunately, it confirms that the problem is not only coming from new stores. Same-store GMV growth turned negative in Q4 2024 and reached almost -28% in Q3 2025. It improved to -16% in Q1 2026, which is encouraging directionally, but existing stores are still generating materially less GMV than a year earlier. This is one of the biggest differences with Misue. Based on the figures we discussed in the previous video, Misue didn't experience anything close to this deterioration in store productivity during 2025. One major explanation is the price war between JD.com, Alibaba, and Meituan. Misue participated much more actively in the promotions and benefited from aggressive subsidies on low-priced drinks. CHAGEE deliberately avoided competing as aggressively on price because management wanted to protect the premium positioning of the brand. That decision may make sense over the long term, but in an environment where Chinese consumers are becoming more price sensitive and competitors are heavily discounting their products, there was clearly a short-term cost in terms of volumes. The customer data points in the same direction. Personally, I wouldn't pay too much attention to registered members because someone can register once and then stop consuming entirely. Active members are much more interesting. Under the old definition, active members fell from around 45 million in Q1 2025 to 35 million in Q3. Then CHAGEE changed the methodology from Q4 onwards, after which the figure suddenly returned to 44.7 million and then 50 million in Q1 2026. I really don't like this kind of change. Maybe management has valid reasons for using a new definition, but from an investor's perspective, the result is that we lose comparability exactly when the previous indicator was deteriorating quite clearly. If we now move to profitability, the deterioration is also very visible. CHAGEE was generating operating margins above 20% during most of 2024 and again in Q1 2025, before profitability became much more volatile. Part of this comes from share-based compensation. This explains most of the collapse to 3.2% in Q2 2025, when CHAGEE recorded around RMB 553 million of SBC, mainly related to the IPO. We will come back to this later. Marketing expenses have also increased significantly compared with early 2024, while store productivity has moved in the opposite direction. So CHAGEE is spending considerably more to support the brand, without seeing that spending translate into stronger domestic sales. Q4 2025 was another unusually weak quarter, but for different reasons. SBC was much smaller, while CHAGEE was dealing with lower revenue, an internal restructuring, and a transition in its business model. Management estimated the impact of these changes at around RMB 320 million. The recovery to a 15.4% operating margin in Q1 2026 suggests that part of this cost was temporary. One part of the cost increase, however, could be more structural. CHAGEE has started taking over a much larger number of franchised stores, with company-owned teahouses increasing from only 169 at the end of 2024 to 790 in Q1 2026. The company doesn't generally buy the real estate because the locations are leased. What it takes over is essentially the operating business and its equipment. More importantly, CHAGEE then becomes responsible for employees, rent, utilities, and the other store-level costs that were previously borne by the franchisee. So as more stores become company-owned, more operating costs move directly onto CHAGEE's income statement. The timing also raises some questions. Store productivity has fallen considerably, and CHAGEE can take over locations when franchisees decide to discontinue the business. We cannot know how many of these conversions are linked to franchisees finding the economics less attractive. But given the current environment, I think it's a possibility worth keeping in mind. The impact on earnings per share is quite clear. If we use Q3 2025 and Q1 2026 as the two most recent relatively normal quarters, GAAP diluted EPS averages around RMB 2.2, compared with roughly RMB 3.7 before the deterioration. So we are looking at a decline of around 40%. Even on a non-GAAP basis, the average is closer to RMB 2.6, which remains roughly 30% below the previous level. All of this is also reflected in free cash flow per share, which fell from around RMB 15.5 in 2024 to only RMB 4.3 on a trailing 12-month basis in Q1 2026. So it has been divided by more than 3. The explanation is largely what we have already seen. Lower profitability, more investment as CHAGEE expands and take over stores, and more recently, a negative working capital effect. So cash generation per share has deteriorated very significantly alongside earnings. If we now move to valuation, the stock price performance since the IPO has been pretty disastrous. CHAGEE traded at around $32 shortly after the IPO in April 2025, compared with only $10.18 today. So the share price has been divided by more than 3 in a little over a year. If we annualize the EPS from Q3 2025 and Q1 2026, we get around RMB 8.6 to RMB 8.7, or roughly $1.3 per share. At the current share price, that gives us a P of around 8 times earnings, which looks very cheap at first sight. The problem is whether this level of earnings is actually sustainable. When I initially invested, I was looking at the 2024 and early 2025 figures, when earnings per share were almost twice as high. Relative to these numbers, the valuation didn't look particularly expensive. But the earnings power of a business has clearly deteriorated since then. So even though a P of around 8 looks attractive, I don't think we can simply assume that the current EPS is a stable base. One positive point, however, is that the share price finally seems to have stabilized somewhat around the $10 level after the almost uninterrupted decline since the IPO. For full transparency, my average purchase price on CHAGEE is $19.75. So I'm currently down almost 50% on the position. When I invested, I knew that it was a relatively risky bet because the investment case relied heavily on the IPO figures and the first results published after the listing. I understood that those numbers might prove unusually strong, but I didn't expect the deterioration to be this severe. Clearly, I bought too early and too expensive. This is also why position sizing matters. Given the risk I saw at the time, CHAGEE represented only around 1% of my portfolio. And since my initial purchase, I haven't averaged down because the following quarters were disappointing and I didn't have enough visibility on the direction of the business. At the current price, however, there are 3 points that make me consider lowering my average costs. The first is precisely the increase in company-owned stores. I don't like the impact this has on margins, and the economics of a franchise store are clearly more attractive, but if CHAGEE wants to take over some of these locations, I would rather see the company do it during a difficult period when sales per store are down almost 30% than when the business is operating at peak performance. If store economics eventually recover, these acquisitions could look more attractive in hindsight. The second positive point is overseas growth, which remains one of the strongest parts of the business. The third point is probably the most important at the current valuation. CHAGEE is extremely cash-rich. At the end of Q1 2026, the company had roughly RMB 7.95 billion of net cash and short-term investments, or around $1.18 billion. With a market capitalization of roughly $1.95 billion, this represents around 60% of the company's current market value. Management has also authorized a share repurchase program of up to $150 million. At the current market capitalization, if the entire program were executed, it would represent approximately 7.7% of the company's value. Of course, this is only an authorization, and there is no guarantee that management will use the full amount. This is particularly relevant because SBC is not going away. Q4 2025 and Q1 2026 averaged around RMB 63 million of SBC per quarter. Annualized, that is approximately RMB 250 million, or around 2% of the current market capitalization. So the maximum buyback program represents roughly 7.7% of market cap, compared with an SBC run rate of around 2% per year. If management actually executes a meaningful part of a program, it should therefore be large enough to offset a substantial part of the dilution pressure. Thanks for watching this deep dive until the end. If you found it useful, feel free to like, subscribe, and share.